which will be reacting to earnings. And otherwise, what do we have? Opening bell, the Nifty starts about 1.25% higher. We are up at 24,270. The Sensex is at about 79,485. The Nifty Bank is starting about 1% in the green. Nifty Bank, of course, has been the problem child. Mid-cap index is up nearly 2%, 56,530. And I think, the IT index up on your screen as well. Look at the market breadth, advanced decline out of the gates. Very strong, but also very early. IT index is up 1.7%. So this is a strong start, something similar to what we had yesterday. And then, of course, there was a bit of fading which happened, tapering off which happened. But 280 points on the Nifty, 24,273, all about stocks. So let's get to it.
Okay, so in terms of the stock action, just want to start with some of the movers and shakers on the earnings side, actually, to see if Lupin is popping. Lupin is actually up about 3%. That's a very, very strong number. PI Industries is the other one that's having a good reaction to results. But more on results in just a bit. On the large cap screen itself, what's leading this charge? Infosys right on top. M&M, which has had a serious drubbing in the last couple of days, lots of profit taking. That stock is recovering, 2.5% up. You have some names from the PSU pack, ONGC, Coal India that are starting the day positive. There's also Wipro and Tech Mahindra along with LTI Mindtree. So IT is a very clear, strong space. HCL Tech as well. This is a trend that's continuing from yesterday. The rush to mega cap IT in India, by India standards, mega cap. Okay, what else? Maruti Suzuki from the auto pack is looking quite decent. Shriram Finance is up and about. By the way, in auto, so count that as a second trend because M&M, Maruti, along with the Hero Moto, so a lot of the auto stocks are also bouncing back. Let's see what's on the other end of the spectrum. Actually, nothing. All stocks are in positive territory for what it's worth. Even your banks, so the likes of Kotak Mahindra Bank on the positive side, HDFC Bank is contributing 1% higher. ICICI Bank is 1% up, as is State Bank of India. So banks are contributing, Reliance is contributing, auto is recovering, and IT continues to charge ahead.
Well, that's right. Well, just keep an eye out on TVS Motor. That's the big mover in today's trading session. It's up close to around 5%. I think the numbers came in yesterday, so that one, in fact, is up for you on the screen. Keep an eye out on NMDC at the bottom of your screen. You have those flashes. We understand that they've gone ahead and they've cut prices yet again by around 500 to 600 rupees on both lumps as well as fines. So NMDC is a stock that currently is holding in the green, but this follows a 500 rupee price cut just a month or so ago. So that's another stock that you should be keeping on your radar. What else is doing well? Oil India. That stock is up close to around 4%. So that one's blazing away. PI Industries, as well mentioned, it's reacting to numbers, so good going out there. Bata is a little bit subdued in today's trading session. A few more notable movers from the broader markets. MTNL is down 2%, one of the top volume movers. I think around 10 sessions ago, the stock was at around 95 rupees. So that's the fear with some of these companies, right? They move up on various expectations and that doesn't play out. The stock is down from 95 to around 65 rupees in a matter of 10-12 sessions also. Big downtick is what we're seeing on that one. VIP Industries, the numbers are quite disappointing. That stock as well is under some pressure. Suzlon has done some inorganic growth. The street likes, that, and we'll get the management in just a bit. So good move out there. JTL Industries, yesterday it ended strong. Today as well, the stock had opened up in the green. Nuvama has come out with an initiating note with a target price of around 300 rupees. So it's up 3% getting into today's session. And today it's building on another 5% odd. Solid start, guys. Let's hope we end somewhere close to these levels.
Okay, so that's the market for the time being. The market breadth is also, very solid, at least for the time being. 1,900 stocks up, 145 stocks on the way down. Mid-cap index up about 1.5%.
I think typically what happens is after you have these broad corrections when everything else gets ignored, 2 days, 3 days later, market starts to pick out individual stories which were ignored. And this is the earnings season as well, right? So I think over today and tomorrow, you'll have, this stuff playing out as markets settle, as some of the broader macro-driven concerns settle down. You will have individual stocks which have been sold, which did not deserve to get sold. They a little more discerning in that sense. So we got the top volume-led gainer, by the way, is Zomato, right? I mean, Zomato is up 3.5%. At this stage. Remember that the earnings reaction high was 278 on Zomato. And then, of course, over the next couple of days, the low was 247. Stocks at about 260 right now. So it's coming back up. Numbers, of course, were solid. Lupin is up, is the second biggest gainer. We were talking about the 20% EBITDA beat, 3.5% higher, 1975. Second biggest volume-led gainer. Infi is up 2.5%. That's the reason why you got the IT index and the strength there. We were talking about Suzlon with Deven earlier, 4% on Suzlon. So stocks at about 69, that acquisition coming through. PFC is up about 2.25%. And PFC and REC did well, then sold off, and they're back up again. But lots of interest in this space. Cochin Shipyard is down 4%, and that's coming up as a large volume-led mover as well at this point in time. CAMS also reported numbers. CAMS is up 4%. KPR Mills, I mean, these entire textile, apparel, garment makers were in focus, and I think they're today as well. KPR is up 4. Gokuldas Exports, which went up 12, I think by close was up 12-14%. Gokuldas is above 1100 now. So from 900 to 1100, just like that, in 2 sessions. Of course, 900 plus something. But it's a big move in 2 days. Upwards of 15% at least. TV18 Broadcast is up 5.5%. That's the company which owns this owns the channel that you're watching. Triveni Turbine is up about 3.5% as well. So this is, I mean, the picture as we sort of look at markets at this point in time. I mean, these shipping companies are, I mentioned Cochin, but it's not just Cochin. Garden Reach is also down 4%. So keep an eye out on these. And I think Surabhi and Nigel mentioned Gland, which is down about 8%. So that's the biggest volume-led loser here. Harish Krishnan is with us, Co-Chief Investment Officer, Head Equity, Raditya Birla Sun Life AMC. Harish, good to have you with us here. Thank you very much for your time. You know, Sanjeev Prasad of Kotak Institutional Equities was pointing out, and of course, he's long been skeptical of some of the valuations and where we've been trading. But he mentioned something interesting. He said, well, the last 2 or 3 days of the sell-off that we've seen, it remains to be seen whether it will test the conviction of non-institutional investors, as he called it. Retail mostly is what he was referring to. So let me ask you, over the last 2 days, I mean, you'd have the data. Have the flows remained as robust and strong to kick off this conversation, Harish?
Good morning, Prashant. So I think 2 days is too short a time frame to change the habit, and a habit that has been inculcated since COVID lows. So you've had a 4-year kind of a move wherein corrections have been far and few, and they've been vociferously bought. And if at all, I guess the takeaway is that even this correction, led by global forces and macro, has been quickly bought in, not only in India, but even across the world. So I guess the habit-seeking change possibly that you're referring to, at least given the last 3 months, wherein you've had reasonably fundamental setbacks, be that of the elections, be that of the budget, increasing capital gains tax, be that of even poorer earnings print that is starting to come through, and then the macro headwinds or the macro change led by the Japanese yen, unwind of carry trade. I guess all of these dips have been vociferously bought. So if at all, it is further reinforcing that habit rather than taking away from the habit that they have learned over the course of the last 4 years.
Harish, I remember when you were, and correct me if I'm wrong here, but just going on a limb here, but you were with us on that on an editors roundtable program, and you did mention that the biggest risk for the market, as you see it, I think you said it was the yuan, and what that currency does. It's been the yen, which is it's the currency still, or it's the yen, not the yuan. I mean, just wanted to update to your views, Harish.
Prashant, it's nice of you to remember. Yes, I did mention both the yen and the yuan, but clearly the bigger, given the fact that it's been a peg all throughout, I would still think that the yuan has got possibly a far bigger wrecking ball, if I may, should something happen out there. Clearly, from a perspective, we are seeing fault lines emerge, wherein the largest economy, US, is slowing down significantly. You are seeing divergences in Japan, and this is where I guess there is a fault line emerging, which is where one is seeing what one has seen over the course of the last 2 days. Having said that, I was just looking at data before coming onto the show. We've actually, when we look at positioning, and this is data that various bankers kind of give us, it does appear that a lot of the unwind is behind us from a data point of view, from a positioning point of view. Of course, in that context, today's monetary policy briefing by the Bank of Japan is still crucial from an incremental positioning point of view. But I would say that, the big delta change that came through over the course of the last week seems to be a lot more settled when I look at data as far as positioning on the currency is concerned.
Harish, hi, morning. I don't know if you could listen into the conversation just before you. There was Chris Wood speaking to our colleagues in Asia, and he was making that point, right? The surging domestic liquidity, mutual fund flows, and we're getting the numbers again on Friday. I'm bracing myself. Last month's number was 41,000 crores coming in, right? So let's see what we get this time. But for instance, that's one view. That's why he's turning tactically cautious. This wall of money is just, making the market absolutely super resilient, bulletproof. Now, is that something that we can take heart from and just keep buying, or should that be concerning even domestic investors? How do you approach this market?
I think it is definitely concerning from a domestic investor base, because ideally we want to buy companies which are anchored on the fundamental side, because as we all know, markets are slave of earnings. So while we can keep talking and analyzing about liquidity and see where the marginal buyer is coming from, the reality is that sentiment, liquidity, all of them can potentially change a lot more faster than what earnings and profitability and book values of various companies. And therefore, we place a lot more focus on fundamentals than on liquidity. Having said that, I still think that, possibly, even as we keep tracking the mutual fund data points, I think the big surprise from a pre-COVID to a post-COVID is not so much the flows that have come in through the mutual fund or the institutional platform, but clearly what has happened on the retail and HNI. And that really has been a big surprise, because if you look at the 10-year data prior to COVID, retail and HNI were net sellers of Indian equities, and they have turned into massive buyers, and they've continued to pour in with significant strength. So I think the real key difference or delta change is in terms of what is happening as far as the HNI circle or the HNI retail circle is doing in terms of setting up prices. And while we have some theories, we do think that liquidity cannot go on forever, but it does appear that for now, given whatever they have seen and encountered, liquidity is still very, very strong and buoyant.
Okay. So if that's going to continue to be the case, I go back to the question, what should one be doing in this market? Do you expect any leadership changes, for instance? The last 18 months, it's been capital goods, CapEx, the manufacturing side of things. Does it make sense putting in more incremental money in FMCG? Again, I'm just saying, if a retail investor wants to get a little tactical now, what should he or she be doing?
Right. So I think, we are cognizant of the fact that India's macro story looks extremely good. Yes, valuations have run up a bit ahead of themselves. More importantly, when we look at the data and we look at, say, pre-COVID till now, and we're talking about now close to about 3.5, 4 years, it's a long period of time. If I look at large, mid, small, and micro cap, first coming to the market cap story, and then I'll come to the sectoral question that you asked. So from a market cap perspective, if I were to look at large cap, the top 100 companies, the entire delta increase in their market cap can be more than explained by the earnings that have come through. In a way, valuations have actually compressed by a tad bit. If I look at the same data for mid caps, close to about 67% of the market cap increase is explained by earnings, and about 1/3 is explained by valuation expansion. If I go into small cap, it is 50-50, and if I go to micro cap, it is about 1/3 explained by earnings and 2/3 explained by valuation. So therefore, we do think that risk has got disproportionately rewarded, and it does make sense to tone down some element of risk in our portfolio. So if you are big time into small cap, we suggest to move into mid caps. If you're into mid caps, move down to large and mid caps, etc. So that is as far as what we think from a market cap perspective. From a sectoral perspective, we do think that there are trends changing in terms of some big sectors which have led the recovery so far. Calling out two specific candidates out there, I would say one is pharma, which has been a silent performer over the course of the last two odd years. But I think that there is a far bigger potential that is emerging as far as pharma is concerned in terms of the ability to outperform. Do note that pharma's peak performance peaked out in 2015. So we are talking of a long cycle of consolidation which is starting to emerge out, with earnings proving to be beating for most companies. Of course, pharma is a very heterogeneous sector, and therefore one needs to be a lot more bottom up out here. But I would say that that sector continues to potentially lead. Even in the last 3 months, it is kind of led from the front. The second space which is starting to look interesting, I would say, is consumer durables. This has again been a space from 2019 where it has kind of underperformed. Over the course of the last 6 months, yes, the summer has been very good, and therefore there has been an uptick. But even otherwise, I think the competitiveness and the profitability metrics of this sector is, I think, changed quite dramatically. The third, I would say, which is starting to emerge, possibly still some time away, I would say, is cement. Yes, the near term doesn't look very encouraging from a pricing point of view. There is a reasonable amount of consolidation which is happening. But in our mind, cement is a proxy play of energy because at every stage of manufacturing and freight, it is a very energy intensive kind of a commodity. And we do think that energy prices have kind of cooled off from that $70 to $90 band, and in case President Trump does make it, we do think that there is a potential that crude can settle even lower. So I would say these are the three packs that look interesting from a sectoral leadership point of view, from the next 18 to 24 month point of view.
Those are some really interesting thoughts. Never thought of it that way. Cement being a proxy play to energy. So pharma, cement and consumer durables, three sectors that perhaps investors can start looking at as they look at tweaking their portfolios. Thank you very much, Harish, for joining in. Great conversation and good perspective. Appreciate you being with us. You have a good rest of the day. So Nigel, you heard it. One of the three sectors is consumer durables. I think on cue, we have a big company joining us now.
Well, let's get straight to it then. Let's focus on Blue Star, which reported a good operational performance. Mr. Advani, the chairman and MD of Blue Star, joins us on the show. Hi, Mr. Advani. Good morning, and thanks a lot for joining. And congratulations on a solid showing. Reading a note earlier this morning, and they mentioned that what stole the show in the past quarter is your margins. MEP coming at its highest ever seen, and UCP at the highest since the first quarter of FY20. What's the outlook on both these two segments from here on, Mr. Advani?
So good. Thank you so much. Good morning, and thanks for having me. I think it was a good quarter. You saw revenue grew about 30% to 2,865 crores. The good news, like as you mentioned, is that we had strong growth and, more importantly, very good operating profit improvement in both segment one and segment two. Segment one, which is our electromechanical projects business, growth was about 9.5% to 1,040 crores. But you saw a significant improvement in operating margin there. That was on account of our commercial air conditioning business. We had a very good quarter. There's been margin improvement on account of total cost management programs that we've been running in that business. So we're very optimistic about the future of segment one as we look forward into the year. Segment two, which is room air conditioners, had a great quarter. We grew both between refrigeration and room air conditioners, we grew about 40%, 44% to 1,730 crores. Again, EBIT margin improved to 9.1%. That was largely on account of scale. We had a great summer, as you know. I'm sure you'll ask more questions about that, but it was a scale that drove the profit improvement.
So what you're telling us is that these margins are sustainable at these levels, the 9.1 and 9.9%?
No, so quarter one tends to be very strong for segment two, which is summer-driven quarter. We expect the full year for segment two to be about 8.5% or so. Whereas in segment one, we had some large project orders that closed, as well as some margin improvement in certain orders. So we did report 9.9%. I think about a 7.5 to 8% EBIT margin for the full year is what is sustainable.
Okay, so that's unchanged then, right? Because I think you've told us earlier as well, Mr. Advani, hi, morning, Prashant here, that blended EBITDA margins should be about 8.5% for the full year, FY25.
Yeah, so Prashant, I think that from the last time we had spoken, we would have adjusted it up by about 0.5% across both the segments. So we're looking at doing, I think 8.5 to 9% on aggregate should be a good target for us.
Okay, 8.5 to 9. And 20% revenue growth for the full year?
We're hoping to do better than that. Of course, the summer is very strong. Of course, a lot depends on the second summer or the festival season that's coming. We're planning for strong growth, so I hope to do better than 20% for the year.
25?
Yeah, I guess a range would be 20 to 25% is what we're targeting to do. But of course, a lot depends on how the festival season turns out.
Okay, 20 to 25% revenue, and margin should be 8.5 to 9% on an overall basis. And of course, I mean, cooling demand sort of is, I think, the single biggest source of, I mean, when you look at breakup power demand, I think cooling is going to be essentially the largest, I think still is the largest constituent, will be the largest, bigger constituent over the next several years and decades. Those are estimates. So in that sense, you find yourself in a good place. But there's one thing I've sort of, we've spoken earlier as well, is competition, right? Lots of people have said that there is no real price leverage in the system because of a lot of the capacity which is coming on. Industry is adding a fair bit of capacity. So I just wanted your sense on how that is, how you see that shaping up.
Sure. So, pricing and margins, of course, go very tightly together. In segment one, I think that, our business strategy is very different. We are very selective about the business that we book. Of course, it's a B2B business, so it is easier to do that. And you can see year on year, we're delivering that improvement in margin and continuing to grow at a reasonable pace. Segment two is where you're highlighting is the extreme competition. And, in many ways, the price is determined by the market, not by someone like us, especially because we're a number 4, number 5 player. I think that as I look forward, of course, we've all been concerned about the large amount of capacity that is coming online across many brands. But if you look at this last season, of course, the market grew over 50% as far as room air conditioners are concerned. Of course, a large part of it had to do with the summer, no doubt. And we get once in 3 or 4 years, we get a golden summer, as we're calling it, and we got that this year. But even if I strip out that bump up on account of the hot summer, it was very strong basic demand across multiple towns and cities in the country. And so we feel that there's a structural change in the growth rate of our industry. And with this, if we're able to sustain this for a couple of years, I think that the market will absorb this additional capacity that had been planned. The other thing is that I think all the large OEMs will have all their production online by the end of this year. There are a couple more large investments that are pending from the top 5, 6 brands. I think as those come on stream, we're seeing OEMs focusing on assembling products, and we're seeing contract manufacturers focusing on the component ecosystem. So I think it will evolve over the next 3 or 4 years where we will have adequate capacity. Of course, there will be some amount of excess capacity, but not as bad or as large as we had thought a year or 2 ago.
All right, Mr. Advani, you're guiding for 20-25% growth. How much will exports contribute? I wanted to understand, what has been the response to the trial orders. So for this year, exports will contribute how much to the total pie? And I believe in the next few years, you're looking at becoming a bigger player in the global market. So where do you see that number headed?
Sure. So I think this year the number will be only about, I'm going to say 400 to 500 crores. So still a very small business. Our trial orders have started to reach some of these markets. We've got product in market in the US. We've got product in market in the Netherlands. Very good acceptance of the products, even though it is early days. But as we've told you in the past, this is we're addressing the decarbonization of heating and cooling in these markets. And there's a transition period for this because, we're not going after an existing old market. We're actually going after a transitioning future market. And so some of our growth will be determined by how quickly the market moves towards these decarbonization solutions. So we're patient. We're also learning. We have a long runway to go in terms of R&D, in terms of manufacturing quality, in terms of customer acceptance. So my request is that give us several years. I don't think this is going to deliver results in 1, 2, 3 years. We're asking for 5 to 10 years to build out this business, but that's the kind of outlook that we have. It's going to be obviously over a 10-year period, a very exciting business for Blue Star.
Let's extend the long rope then. If you do 500 crores this year, in the next 5 years, where do you see that number headed?
So we don't look that far out as far as a new business is concerned. I think that we're just building it step by step. So really, honestly, the next 3 to 5 years for Blue Star is very much about the domestic market and about domestic demand. You know that currently we're spanning right across refrigeration, residential air conditioning, and commercial and industrial air conditioning. It's a very wide portfolio that we have, and there's growth opportunities in all of them. We didn't talk about the refrigeration business, but things are looking good as far as that is concerned as well. So overall, we're a domestic play for the near term. We're a global play for the long term.
RAC market share, what is it and where is it headed?
We held our market share this summer, 13.75%. We wish we could have done more. We would have done more if we had more capacity. As you may know, there were stockouts across the industry, including in Blue Star. So we did lose some amount of business that would have allowed us to inch up our market share. But we're happy that we were able to retain our market share in spite of the stockouts that we had.
Okay, all right, Mr. Advani, we appreciate you joining in and giving us all those cues. So margins in that vicinity of around 8.5% to around 9% approximately. Growth of around 20 to 25% for the time being. A domestic player with an eye on the export market as well. Thanks a lot for joining in.
And Mr. Advani, you called it once in a while you get a golden summer. I think it's becoming more, not once in a while, but every now and then.
Well, I don't wish it on the world, but yeah, you're partially right. You're absolutely right.
Yeah, no, it is what it is, right? So it provides that tailwind as a business. Thanks very much for joining us. A great conversation. And look forward to our next one. 260 on the Nifty. We're about 24,255 on the index. We're going to take a break. Suzlon has done an acquisition, and we'll talk more about that with Mr. JP Chalsani, CEO of the company. He joins us in just a bit.
Welcome back. So the color is still very much green on the screen. So let's keep the corporate conversations going. Suzlon is on our radar this morning. The company will be acquiring a majority stake of around 76% in Renom, a renewable energy operations and maintenance service company. The company will acquire the stake in two tranches over the next several months. To talk about this, we have with us Mr. JP Chalsani, CEO of Suzlon. Mr. Chalsani, great to have you back on. And this is quite interesting because this is a business line that you already have. I'll just sort of point this out for the benefit of our viewers. and energy operations and maintenance services, right? But I think the business that you have is captive. It only takes care of, I think, Suzlon's requirements. But with this acquisition, is the idea that you want to branch out and expand this as a wider business opportunity? Tell us more.
Yeah, no, let me just, first of all, good morning. Thanks for having us here. Let me clarify that when you talked about 15 gigawatts of Suzlon captive, it is not actually captive. What we do is that every single turbine we sell, we also provide a long-term service contract to our clients. So this 15 gigawatts, what we operate is for the different clients. So today, the market, today the installed capacity in India is, let's say, about 47 gigawatts. So out of that 15 gigawatts is what Suzlon capacity, entire 15 gigawatts is operated by us for the clients. There is a 32 gigawatts outside Suzlon, non-Suzlon turbines, which are being operated by the different OEMs or the ISPs, and some of them being done by self-OMS. The Renom is in the business of doing the non-Suzlon OMS business. They already have about 2.5 gigawatts, out of that about 1.8 gigawatts is the non-Suzlon. What this equation does for us is while Suzlon continues to grow its fleet, when we keep doing our own sales, which is growing, you know that our order book currently at 3.8 gigawatts, we continue to grow Suzlon sales, which automatically will get added to our fleet. 15 gigawatts will keep growing, but this 32 gigawatts, which is existing today, plus let's say our target for the country is to reach from 47 to 100 gigawatts. So there's another 50 gigawatts getting added. In that, if I take away the Suzlon portion, there is a significant non-Suzlon turbines also getting added. So there is a large pie of 40-50 gigawatts of non-Suzlon turbines opportunity available for us to take. So that is what is the synergies between us and the Renom. Would provide that while Suzlon used to grow its own fleet, its own service business, this platform gives us to grow the business of non-Suzlon, what we call as a multi-brand OMS.
Sir, that's good context to have, but I just want to understand whether going forward you will look at merging Renom and your own, Suzlon OMS business. Is that something you're looking at? But I don't know how that works, because I believe the margins of your OMS business are very healthy. In fact, in the last quarter, they gave a good boost to the numbers. So just give us an idea also of the size. Right now, the Suzlon OMS business, how much is it at an annual basis? What's the run rate? Where do you see it growing to? Now, those margins, I believe, are 42, 43%. So is merging these two even a possibility in the near future?
These two are completely in a different, they are in the service business. There are synergies to that extent of overall technology supporting it. But these two are two different segments. What the Renom does is the multi-brand OMS. And they have established a good business there. They are the largest ISP in this segment, today with 1.8 gigawatts. In the last, take the last 4 years, the CAGR of growth has been about 29%. That business model itself is different, partly comprehensive OMS, partly non-comprehensive OMS. So therefore, these two cannot be compared, these two cannot be merged. So as we said in our press release as well, this would be an independent board-managed ISP, which will continue to grow in non-Suzlon brand, and Suzlon would continue to grow in the Suzlon brand. There is a huge amount of synergies between the two, but we don't need to merge two companies. And we continue to operate in its own space. When they were growing at 29% on their own, because they built a good brand, now we can imagine that with Suzlon backup, growth rates are expected to increase further.
Yeah, okay. Mr. Jalsani, hi, good morning. Prashant here. So this is, this Renom has got about 2.5 gigawatt, right, of contracted capacity.
Yes.
FY24 PAT was about 20 crores. Could you, what does this get you? I mean, because you already do this business, not just for turbines. I mean, right now you do it for turbines that you sell, but, they do it for others as well. My point is, does it get you expertise which you could not, you could have sort of gone after this market within Suzlon? I mean, does it get you personal expertise? Does it really add to the size and heft? I mean, that other portion which you said you can go after now, which is non-Suzlon, apart from the 15, you could have gone after it without this acquisition, isn't it? Just trying to understand.
Prashant, it's an absolutely valid point. We could have done our own as well. As I said, that these two are today. In fact, we have been trying to do that. In fact, today we do have about 230 megawatts of non-Suzlon models, which we're taken to see that how to operate those things. It's much easier to operate our turbines versus other turbines. One option we had was that we grow on our own in this area. Second option is that there is an established platform which has been growing significantly, which has set up its own systems and processes. It gives you a leapfrogging into this business. So what it provides us is straight away, like with our 230 plus that out of the 2.5 gigawatts, about 1800 megawatt is wind. So straight away we'll start with 2 gigawatts of non-Suzlon turbines, this thing. So therefore the starting point is completely different. Plus, as I said sometime back, the model for non-Suzlon turbines, when you talk about multi-brand OMS, is different from what we do for Suzlon. The cost structure is different, what products we offer is different. So therefore, we just wanted to keep these two independent and run differently, keep the two different cultures separately. And this platform, what it does is that it's a good platform, largest ISP, gives us that initial platform for us to leapfrog into this because the potential is huge. And also, Prashant, one we need to understand is that this is not just growing the business in service sector. What it does is that the WTZ sales business is a bit of a cyclical. In FY17, we did very well. Then you had this tariff-based bidding, the whole country's things have come down. Whereas during that period, as well as when we had the financial issues, the one which supported us is our service business, because it's an annuity type of business, it continuously keeps giving you the cash flows. So therefore, increasing our service footprint quickly would provide us further stability for a cyclical business like WTZ. So I think that's also as a strategy for us to ensure that when we are now come back into a real these things, to have a sustainable growth where we insulate ourselves with the market fluctuations to the extent possible. So therefore, this is one way to increase service business significantly through this platform. That's the strategy.
All right. Hi, sir. Morning and good to see you. Give us a margin profile of both the businesses, the acquired business as well as Suzlon's business. And when do you see it come up to steep with what Suzlon's doing currently?
I wouldn't like to compare the two models because, as I said, the models are different. It's unfair to compare the two. Suzlon, you have seen it, obviously, that we have been at 40% plus sort of an EBITDA margins. This business at this scale, last year, the numbers are out there, and there are at, let's say, about 20% of EBITDA margin. But then that fleet today is 2.5 gigawatts, out of that 1.8 is wind. And second is that in Suzlon turbines, every turbine is a comprehensive OMS. Scope is different. Whereas for this 1.8 gigawatts, they have different types of contracts. Something is comprehensive, something is semi-comprehensive, something is pure technical support. So therefore, it's unfair to compare the two, saying that when Suzlon is making 40% EBITDA, why is 20%? I think in the ISP sector, the independent service provider sector, both in India as well as abroad, when you see this company is doing pretty well. With respect to
yeah, so sir, just to conclude that, so you're happy with these margins at around 20%, or is there scope for it to improve? We get that point. You're saying it's not directly comparable. We should look at it differently. Where do you see this 20% scaling up to?
As a CEO, I can never say I'm happy with any margins. We always look for the margin.
So what's the target? What's the aspiration then?
Look, I can't put a number to it, but as I said that as at the point I was mentioning some time back, they have been growing at the CAGR of 29%, okay, on their own. And now with Suzlon coming in, you can expect the growth to happen differently. And also with our backing, the model of contracts could change. So that would also improve the margins. We expect that margins would significantly improve, but I don't want to put a number to it.
Sir, just to go back to the strategy point that you were making earlier, that in some ways this also kind of provides a second engine, de-risking the model, right? In the periods when wind turbine generator sales are not soaring through the roof.
Oh.
The company that you've acquired is about 213 crores. It's a very small acquisition compared to Suzlon's size. What is the size of your own OMS business at present? If you could just give us the annual revenue number. And since the possibility is very huge, give us a projection. I mean, this acquisition and your own internal business put together, can it, say, get to, I don't know, 700-800 crores revenue, 1,000 crores revenue? What is the scalability, since that seems to be a very big objective behind doing the acquisition?
Anyway, the question, different ways coming back to the same thing. Let me try to answer this question. First, let's look at Suzlon own business. Today, we are the top OMS company in the country. Not just the top service company in the country, that if you look at across the power sector, including the fossil fuel,
Right.
we are 5. So NTPC leading the pack, we would be number 3 or so. Across the power sector, operating assets. We are growing significantly, our own turbines. Right now with 3.8 gigawatts, we expect it to grow significantly between now and 2030. If country is going to add, let's say 50 gigawatts between now and 2030, you can imagine that we always have 25 to 30% market share minimum. So therefore, that keeps adding to our fleet of a business. Okay? That would continue to grow for every single turbine we sell. As our policy, we won't sell a turbine if there is no service contract. So every turbine we sell will keep adding there. That's one growth engine which will continue. Coming to your second point is what needs to be seen today is that, comparison to Suzlon, it may be small. But look at the potential out there. As I said, today itself, there is a 47 gigawatts commission capacity in the country. We are just operating 15 gigawatts, and this company is operating 2 gigawatts. Okay, so there is still a significant 30 gigawatts sitting there. The current thing operated by different OEMs, and some of those OEMs are showing today saying that they are not really keen on long-term stay in the country. Plus, additional capacity what is coming in. What is important to say is not the 2.5 gigawatts what is today. What is the potential to grow from today to 2030 is huge. And if they are growing at 29% CAGR with Suzlon, you can always imagine what is going to be the growth rate. So I leave it to you in your imagination what is the number there. So, but it's unfair to compare today the 15 gigawatts and then they just started in 2015.
Okay. Mr. Chalsani, we wish you the best of luck. Thank you very much for joining us. Sorry, apologies to Barton, but great conversation and great perspective on all counts. Thank you, and good luck with that acquisition. 230 points higher on the Nifty. We're at about 24,220. Mitesh is with us with a quick check on things. Mitesh, view on the index and trades?
Good morning again, Prashant. I think on the index, I'm still hoping that this bounce back will extend for a couple of days more, but ending close to 24,350 and then 24,500. I think these are two pivots where a lot of supply will emerge. So don't be trading aggressively on the long side. In fact, find specific stocks to trade long. And even and around 24,350, I might want to, suggest people to buy into put options. I don't know as the market goes up to 24,500. And then, I think from there we'll see another reversal, which should this time break the lows which we made yesterday and the day before yesterday. Having said that, Arvind Limited is on the buying side. I think that's given a good breakout. Keep a stop at 404 here. Look for targets of 445. Maybe even higher levels to begin with. And on the selling side is Bata with a stop at about 1470 for targets of 1400.
All right, Mitesh, thank you very much for that. Let's welcome in the management of Symphony now. The company reported good set of numbers. Revenue from operations are up 76%. Margins have expanded from 8.6 to 21%. And there is a buyback to boot. We've got the management with us. Rupesh Shah is Managing Director of the company. Mr. Shah, good morning. Great to have you with us here, sir. Congratulations. Prashant, this side. The numbers we'll get to in just a bit. And we just had the management of Blue Star telling us that the environment is looking super solid. And I'm sure you'll concur. But the buyback first. What was the rationale, sir, for the buyback? Because, we're looking at the numbers. Even if you as promoters don't participate in the buyback, the acceptance ratio is going to be minuscule. So does it really benefit anyone who really wants to tender in, and in what way? So what was the rationale and the size of it, essentially?
No, so thanks. As you may be aware, we have a stated payout policy of at least 60% of the profit after tax. And secondly, considering our business model, despite robust and consistent growth, whether for our standalone business or subsidiaries, we don't really need much cash or capex. More than 90% of our PAT is free cash flow. And hence the payout can be in two forms. One is dividend and secondly is a share buyback. By doing the share buyback, number one, we convey in a way what we believe about the future and potential by conveying the price. Secondly, to that extent, it also positively impacts. Of course, it is very small, but about the EPS as well as valuation metrics, and ultimately proportionately it benefit to all the shareholders. And considering the latest budget amendment, end-to-end in terms of the taxation, until 30th September by resorting up to 10% of the net worth. One can conclude before 30th September, and end to end there is a good taxation.
Mr. Shah, my
benefit.
only point is you could have done a larger one, right? Which really, makes a big difference. If the, as you said, the policy is to return so much cash to shareholders, you could have gone in for a bigger sized one. Because, as I said, even if US promoters don't participate, acceptance would be 15 shares for every 1,000 shares.
No, so as I said, we resorted to 25% of the net worth, that is 200 crore plus about 14 months before. And this time for the quarter, the PAT is 88 crore and total payout versus 88 crore, including taxation to bear by the companies in excess of 95 crore. So by resorting to this, we are giving a payout in excess of 100%. And secondly, as I said, if we had gone for a larger buyback size, it would have extended beyond 30th September. Then end to end, the taxation arbitrage we would have lost. In turn, shareholders would have lost.
Hi, Mr. Shah. Good morning. We get that rationale. Are you participating as the promoter entity in the buyback?
Not yet decided. As of now, board has approved this, and board has just conveyed yesterday, and record date is 21st of August. So in the due course, it will be decided. But I see no reason why promoter should or should not participate.
Okay.
Actually, sir, you're sitting on the fence then. You know, the street would like to know which way will you swing, but we'll wait by for clarity on that front. Ideally, if it's for shareholders, maybe the promoter entity doesn't participate. We'll wait by for clarity on that front. But your operational performance has been good. And a couple of brokerage notes are believing that FY25 is going to be the best year in the history of the company. Could you tell us what do you end this year with? To give a reference point, last year your total sales I think were around 1,200 crores with the standalone business contributing 800 crores. So for this year, what do you end with? And also what was record breaking in the past quarter was your gross margins at 51%, EBITDA margins at around 21% as well. Give us a guidance on both those two parameters for FY25.
So as per our IR policy, I cannot share the specific numbers or guidance for the ensuing quarter or the year. But obviously, so far, whatever initiatives and measures we have taken in last 3-4 years in terms of expanding the product range. On top of it, just yesterday we announced launching 17 new path-breaking models in air cooler. In addition to that, also entering into water heater. Of course, in year 1 and 2, it won't be really meaningful. And on top of it, now we have a decent presence in semi-urban as well as rural market on account of continuous expansion. And even our D2C has registered the EBITDA margin percentage in line with the normal business, which was negative until last time. So we are quite confident.
Mr. Shah, we're running a little short on time, sir. Just wanted to confirm that this year will be the best year ever, right? Historically, the best year for the company. And by when do you get to that 30% margins? Very quickly.
Quarter has been the best. We hope it will be and should be the best year ahead. About 30% margin, we are ensuring our and trying our level best to reach to that level. But our June quarter EBITDA margin has been the best ever.
Okay. All right. We'll wait by for further clarity then, Mr. Shah. Appreciate you joining in and filling us in with all of those details. We look forward to this record-breaking year and for clarity on the buyback as well. For the time being, though, we slip into a short break. Come back. Oil Lubricants is waiting for us on the other side.
Welcome back. Gulf Oil Lubricants is the next company on our radar, and the company saw a good performance in the first quarter. EBITDA and profits saw a healthy growth, while operating margins also expanded. Ravi Chawla, MD and CEO, Gulf Oil Lubricants, is now with us. Mr. Chawla, great to have you on. I think your volumes were extremely robust in the quarter gone by, right? I think it was 2x the industry run rate. Just tell us, what are the projections? I mean, so far in the second quarter, are you still seeing that kind of volume growth, and what is the expectation for the year as a whole, FY25?
So the first quarter for us, April, May, June, of course, it comes at the back of a strong March quarter where all our year-end promotions and distributor schemes are on. So good quarter and good uptick in spite of the general elections and the heat waves. I think we've seen our B2C business doing well, particularly the motorcycle oils, the agriculture oils. All-round growth in the industrial segment. A few segments like infrastructure, I think, have been slightly low, and factory fill has been subdued because mainly we do commercial vehicle, OEMs. So I think overall a good quarter. As you rightly said, it's an all-time high in terms of all our numbers, revenues, profits. But as we look at this quarter, obviously the monsoons are where the consumption comes down. But for the year, the outlook is to grow 2 to 3x the industry, which we expect to grow at 3 to 4%. And we're on track to do that with all our initiatives.
So you'll grow 2 to 3 times the industry, which is growing at about 4 to 6%, you said, right?
No, industry growth, we generally take it in the range of 3 to 4 because we also do a lot of B2B and B2C. We are primarily in all segments. So we look at a 3 to 4% and we look at a 2 to 3x based on our market shares and our initiatives.
Okay, fair enough. Let's talk about the improvement that we've seen at the margin level as well. Your OPM levels are at about 13.1%. So just take us through whether this can also sustain, and what is the kind of margin profile you're hoping to close the year with, and also if there's any upward improvement in pricing.
Well, you see, you're absolutely right. It's a balance of the pricing, the competitive levels, and also what we do in terms of our mix. So we've been guiding a margin of 12 to 14%, and I think 13% is there. Obviously, backed by our segment-wise approach, there's a B2C segment, there are higher margin products. So value creation for us is to definitely go for more growth in these higher margin products and segments. So I think 12 to 14 is what we are targeting because we are also growing our market share. So, you have to maintain a balance between both. We could increase our margins, but then sacrifice the volume, market share growth. But we like to balance both, which is to take 2 to 3x the market growth rate in terms of volume. And the value part and the mix part comes in where we want to look at a 12 to 14% band. We'd obviously like it to be higher, but it all depends on the raw material scenario and the competitive pricing.
Okay, so all of this put together, now I'm looking for, some idea about the top line. You ended last year at close to, I think, 3,300 odd crores. Now, given the fact that you're looking at growing 2 to 3 times industry volumes and, the margin promise remains at 12 to 14%, overall top line growth, what should be the expectation for this year?
Yeah, I think currently you're seeing a 9% growth if you look at our revenue overall. And we definitely want to target, a double-digit growth in terms of revenue. And of course, certain segments, certain mix will play out in terms of what we want to initiate. So I think we definitely look for a double-digit revenue growth. And based on the current pricing levels, obviously pricing goes up, then all the pricing goes up. But right now it looks to be stable. So double-digit revenue growth and a 2 to 3x volume growth is what is our approach in terms of our business.
All right. Hi, Mr. Chawla. Good morning. Let me squeeze this one in on the battery business. I think it did around 80 crores in the past fiscal. Is it breaking even? And what is the target for this year?
Yeah, so happy to share that now we are getting, we haven't got there as yet, but the volume growth is there because we have now localized the toll manufacturing for it. But yes, it's a business which we hope to break even this year. And definitely it's in the right direction in terms of growth. Of course, as we look at the various markets, increasing our distribution, taking our distribution points up is the endeavor. So hopefully this year we should be able to get to break even.
Okay, all right, Mr. Chawla, we will leave it on that note. Thank you very much for joining in, and good luck to you and your teams for the rest of the year as well. Well, that's Gulf Oil Lubricants, good quarter and good projection for the year as well. Let's talk about the commodity markets now. We have Manisha with the latest. Manisha, at least on the equity side, there is some calm after the storm. What about commodities?
Oh, well, there is some stability coming in here as well. We've seen good amount of buying in crude oil. The metal prices seem to be stabilizing. There isn't any opportunity buying that we've seen in metals, but an area which has constantly continued to decline because of this rebound is the gold prices. Now we are slipping below $2,400 an ounce for this one. 2385 is the last level that I saw, and an all-time high for gold prices is at around $2,470 an ounce. The futures also have seen prices above $2,500 an ounce as well, but there is profit taking here. One, because you have seen the dollar index rebound from its 7-month lows. Remember, dollar index fell below 103 at one point in time as well. The other is the rebound in equity. So there's money going back in case of equities. We've also seen high-yielding currencies do better, and the risk on is back, and that is what has led to some profit taking continuing in case of gold prices there. But in this case as well, because of the weakness in prices, you have seen OTC buying strong, investor buying seems to be coming up, and also when you look at the speculative net long positions, they also seem to be growing on the higher side there. Well, the street is also looking at a very huge possibility of a 25 basis to 100 basis point of a rate cut, and that could be positive for gold going forward, and that's exactly something that the markets will watch out for. 25 basis point has been long back factored in, so it is really going to be all of the sentiments, statements, and if we see anything more than that is what the investors will watch out for. In the meanwhile, you also have tensions running high in West Asia. Iran has vowed to retaliate against Israel, so all of those factors also will going to be supportive. I wanted to show you on what the gold prices have done in this year until now. So we are up by nearly 16%, and this is after 12.8% of gains that we saw in case of gold prices in 2023 as well. I also want to show you on what the gold prices have done in sense of prices in this year until now. So we started this year with $2,058 an ounce. So where we stand right now at 2385, we are in the positive, as I've shown you 16% of gains in this year until now. But from an all-time high of 2,470, we are down by nearly $100 there. But forecasts going forward for gold have been quite on the bullish side, and that's exactly what the banks and brokerages continue to reiterate as well. Wisdom Tree, the latest report came in yesterday. 2585 is their target for this year. JP Morgan and Citi have been talking about 2500, 2700, 3000 is what Citi has talked about in the next year as well. And that's exactly what Bank of America seems to be talking about as well. Goldman Sachs, the latest report that came in yesterday, talks about 2700. Motilal Oswal, I was talking to them yesterday, 2500 this year is their target as well. So these are good opportunity to buy on dips, as we've seen in case of gold.
I'm rushing now. Now the taxation on gold funds has also become better, right? So I'm going to take your cue, Manisha. An absolutely fantastic rally on the yellow metal over the last 12 months and projections for higher rates. Thanks very much for joining in. We have to take a break right now. On the other side, how is the recent global turmoil potentially going to impact RBI's policy decision tomorrow? Lata will be speaking with Santanu Sengupta of Goldman Sachs and Rajiv Radhakrishnan, CIP of SBI Mutual Fund.
Welcome to It's the Economy. It's a monetary policy special. If the Reserve Bank and the MPC were announcing their policy last Thursday, no one would be in any doubt about it being a status quoist policy with practically no surprises. But the world has turned topsy-turvy in the past 1 week. Rate cut expectations from the Fed, which stood at 25 basis points in September, only one cut in 2024, just 1 week ago, have now increased to 125 basis points of cuts in 2024. Many expect a 50 basis point cut in September itself, if not intermeeting. So is the Reserve Bank likely to sound more dovish or sound different? To answer this, I have with me Shantanu Sengupta, Chief India Economist at Goldman Sachs, and Rajiv Radhakrishnan, the CIO Fixed Income at SBI Mutual Fund. Gentlemen, thank you very much indeed for your time. Well, first, Shantanu, to you. How has the Goldman Sachs view altered about US economy, rate cuts and global economy since the non-farm payrolls of last week?
Yeah, thanks, Lata. So the markets obviously have experienced a sharp de-risking, but that was mainly the unwind of the carry trades, which started with the BOJ and then has been exacerbated with the US employment report. Overall, our US economics team have raised their 12-month recession odds by 10 percentage points to 25%, but that is slightly higher than the historical unconditional probability of a 12-month average of about 15%, because every 7 years you have a US recession, so the unconditional probability would be about 15%. Overall, they still continue to think that the recession risk is still limited, and they're less pessimistic on the state of the US labor market, mainly because 70% of the increase in the unemployment rate in July came from temporary layoffs, which might reverse in the future. They have revised their Fed funds forecast to 25 basis points each now in September, November, and December. They had 2 cuts earlier. And only the risk of a 50 basis points cut in their view comes about if the August employment report is as weak or weaker than what we saw last week.
Okay. Well, let me get Rajiv into the conversation. Rajiv, as Shantanu points out, it's not the market view. The Fed funds rate may be 125 basis point. But, there are a substantial number of people who believe it will be one cut each in September, November and December. But nevertheless, the Reserve Bank is going with a different worldview. So do you think this, first of all, how many cuts are you expecting, and how do you think the Reserve Bank may respond to this changed worldview?
Yeah, in fact, it's quite interesting when you look at the market implied pricing from the Fed funds future. So you did mention about 100 odd basis point. In fact, I think a couple of days back, it was probably 150 basis points of cut priced in for this year. I think a 50 was completely priced in for September. You had one more data point the other day on ISM services, which was slightly better than what the market feared, and you had a bit of repricing again. So I think the moot point here is we have seen these episodes of frequent repricing of market expectations with respect to the Fed policy rate trajectory. And I think at this point in time, from the RBI's perspective, what I would I would look out for is they will clearly mention the risk about which is coming in from external market volatility, because we've seen that happening before. And I think going forward, financial market volatility driven by markets repricing expectations on Fed policy actions, I think that will be a recurrent theme. And I think the RBI should I think they've noted that in the past, and I don't see anything significantly changing with respect to RBI's assessment on domestic monetary policy. This is a risk factor which is there, which has been flagged off before. But I think we need to look at far more data points to really form an opinion whether we are seeing a recession. Growth slowdown, clearly, yes. But is it really going to a recessionary phase? I mean, I think we need more data.
Yeah, we know. It's just that all of us got excited by the SAM rule that unemployment, if it is 50 basis point higher, the 3-month unemployment average is 50 basis higher than the lowest point in the last 12 months, then a recession follows. But
I think
Shantanu,
on that point, ma'am, if I could just add, I think the Sam rule also, I think she's talked about this probably not being relevant in the current context as well. So I'm not really sure to what extent you can extrapolate from that.
Okay. No, fair enough. Oh, I didn't know that Claudia Sam herself had said that. JP Morgan clearly told us it's not relevant. But Shantanu, see, Rajiv also is repeatedly speaking about slowdown, yes, but not necessarily a recession. Will that tell on Reserve Bank's assessment of India growth? I mean, there is a certain global growth that was assumed, and US resilience was very much a part of that. The last time, the IMF and the World Bank actually inched up the 2024 GDP numbers for global growth. So do you think they will give a downward bias to any of the growth or inflation estimates?
See, the RBI's growth number is probably on the higher end of where street estimates are. We are, for instance, about 40 basis points lower than where the RBI is for fiscal year 25. If global growth is slower, which is, then that would bake into our forecast as we would bake that into our forecast as well and probably shave growth a little bit. But I think what the RBI has been trying to emphasize, and the governor has been making this point, the deputy governor, whether it is in the press conference, whether it is in the monetary policy statement, is that the domestic economy is less linked now with the global cycle, especially the Fed cycle. I think they're calling out, we are relatively more immune from the Fed cycle. The main channel of transmission of global monetary policy into emerging market domestic monetary policy is the FX channel. And the whole reserve buildup has been to isolate out domestic monetary policy and therefore just run it on the basis of domestic growth inflation trade-off. So I think with all this noise going on the global front, while they will call it out, I think the governor or the RBI is likely to remind us that domestic monetary policy decisions will remain very much anchored to where the inflation path is and where the growth path is for India.
That's 100% he's going to tell us that. But I'm not asking you about whether 125 basis of Fed cut will impact RBI. I think it will, but that's a separate point. I'm asking you whether will there be a downward bias to growth? Because the world is growing slowly. As it is, I think in your last PMI report, when you analyzed, you pointed out that the export numbers are a little weak, very, very slightly. There could be an impact on Indian growth as well, isn't it? Will there be any indication at all? And even inflation. Look at the deflationary force that China is, casting on us. NMDC today cut, iron ore prices yet again. I'm just asking if there'll be a downward bias in any of his growth or inflation forecasts.
So firstly, on growth. For India growth, clearly, if the global economy is much slower, that will have some downward bias. But I think domestically, given where the fiscal stance is and the fact that personal loans growth, given the macroprudential norms by the RBI, will slow down, that will provide some downward bias to Indian growth as well. But still, we are talking about a number somewhere in the region of 6.5% to 7%, which is fairly solid. On inflation, there are two very distinct parts. On core inflation, clearly global prices is feeding in, core goods inflation is remaining weak. Core services we'll have to see because the housing rents inflation at around 3% at this stage of the cycle is quite intriguing. Food inflation, clearly, there has been upward biases until now. The monsoon has picked up. It's still, the distribution is uneven, and the RBI would like to wait and see where the monsoon pans out until the end of September to take a call on where inflation would rest for the next quarter and thereafter. So I think it's not really a linear question of, if global growth is slower, whether India growth will be materially weaker or not, because, we are still a very much domestic demand-driven economy.
No question of being materially weaker. It's just at best a downward bias getting indicated. Rajiv, to come back to the rates and the stance, when you went into the policy with an expectation of one Fed rate cut, and when you go into the policy with 5 rate cuts expectation, is there a chance that he will flag off a stance change? Not change the stance, but flag it, prepare the markets for it?
I would say that a change in stance possibly could wait a couple of months. That's my sense. But what is important to note is beyond the stance, when you look at where the operating rate is, that's clearly now anchored lower than the repo rate, which is a material. I think that's clearly something that we are underplaying today, because for a long period, we've actually run the system at the MSF or the upper end of the rate corridor. Now, over the last couple of months, clearly with liquidity coming back into the system, we are operating below the policy repo rate. So there has clearly been a better anchoring of the operating rate, which is probably far more relevant from systemic perspective, because even repo rate was at 6.5, we were operating at 6.75 for a long period. But today that's not the case. So I guess what the RBI could have done in that context, they've already done. So a stance change will only happen when they have visibility on inflation aligning closer to their target.
Okay. So very quickly, I mean, I'm warned I'm out of time. Shantanu, what will be the thing that you will look out for as briefly as you can?
I think they will try to tone down their guidance a little bit, from the extreme hawkishness that we have seen earlier. And I would completely agree with Rajiv that, you've already seen a 25 basis points of rate cut through the ease of liquidity and, having the overnight rates closer to repo from the MSF earlier.
Okay. And Rajiv, what will be the one thing you will watch out in the speech?
Just one thing. So I just want to get hopefully some answers on why they're doing OMOs on the screen. That's
okay. All right. We'll try and squeeze that question if we have time. But I somehow expect it to be a way more cantankerous meeting. Already 2 people have voted for a stance change and a rate cut last time. This is the last meeting of the external members. They change after this. And they have a very good reason now to press home their point, because, the global growth is clearly taking a turn for a slight worse. So I'm wondering if something will be flagged off on the stance. I'm trying to make it interesting. I'm hoping it's not just an, as usual, status quo-ist policy. Thank you very much, Shantanu and Rajiv, for enriching this conversation and our understanding. Let's see what happens tomorrow. Wrap up on Bazaar Chartbusters.